people just don't think three-dimensionally. They don't think about the long-term thing, and
Not
they don't
thinking fourth dimensionally, Marty.
exactly, and they don't understand the game they're playing. The moment that money hits your bank account, you are now sitting on the same side of the table with that investor, and that investor is sitting in a poisoned chalice. Congratulations, you crippled the vehicle and then you sat inside, and it's like your getaway car is fucked.
This episode of the Startup Podcast is brought to you by Vanta. You might know that sinking feeling. You're about to land a big contract when they ask about compliance. SOC 2, ISO, PCI, Essential 8. You've just snatched defeat from the jaws of victory. Not anymore. Vanta massively accelerates your compliance efforts and allows you to get those life-changing deals back on track. Don't wait until it's panic stations, though. Get started with Vanta today. They're offering 20% off their prices just for TSP listeners. Do yourself a favor. Hit pause, go to vanta.com/TSP, that's VANTA.com, to get that 20% off. Growth is oxygen for startups. Sooner or later, you'll want to do Google Ads, Instagram, display, TikTok, SEO, what have you. Newsflash, you will not do these well on your own. That's where Insil comes in. There are a lot of agencies out there, but not many of them are rated 4.8 stars on Google. Do growth right. Go to insil.com.au to get in touch and tell them we sent you.
You're listening to the Startup Podcast. This is an educational episode. In-depth masterclasses about the concepts essential to building, running, and investing in Silicon Valley-style startups. Whether you're a founder, investor, or operator in a startup, you'll gain insights into the principles that power high-growth disruption the same way Facebook, Google, and Uber do it. The conversation starts now.
Hey, I'm Chris.
And I'm Yaniv.
And on today's episode, we are reacting to VC horror stories. We put the word out on our LinkedIn, and so if you're not following us there, you really should be, asking for you to tell us about some of the craziest things that have happened to you from and around and with the VCs. We got the full range of crazy stories coming in here, from venture studios acting as VCs, to VCs sharing with competitors, lowball offers, failing to help, delayed payments, and even using fundraising as a weapon and a fake Shark Tank. So we're going to go through these, read them out, and we may or may not protect the names of the innocent. And Yaniv and I will share our thoughts and reactions, and maybe, hopefully, you'll learn how to avoid some of these horror stories yourself.
Absolutely. And yes, thanks so much for responding to the call. We've got some amazing stories. Most of you chose to be anonymous for obvious reasons, and we respect that. But when folks have shared their names, thanks very much for that. And we will share those too. Okay, so we've categorized these into a few different VC anti-patterns. And so the first of these is the sort of things that can go wrong with the so-called venture studio model. And again, I want to make sure that I say that not all venture studios are bad and not all investors are bad, but these are cases of when it goes wrong. Okay, so we've got this first story. He said the investor took 51% of the startup in return for an agreement in writing that they would provide everything required to develop the product, market the product, and sell the product with their substantial global reach. They didn't do a thing. Then I couldn't get any other investment. I wasn't the only startup this investor did this to either. I am the only one who, after years of being stuck, got unstuck and back on track. Oh boy. The second venture studio story we've got is from Michael Kant. And he said, I had a studio, he put it in quotes, I had a studio investor recently who'd exited on a massive deal for their own platform last year, $180 million. They wanted to build my product, but the conditions that it was split 25% each. Now that's fine, but there were 3 of them and 1 of me. So they essentially wanted 75% of my idea. I asked what I was getting for this. They told me one of them was potentially quitting and going to come on board full time. He was also being paid a salary to come on board, plus 25% equity, which was insane. When I asked what the other 2 were doing for their 25%, I was met with, quote, "You're being aggressive and greedy." They were worried about reputation and basically turned around everything saying I was an arsehole for asking questions.
Oh dear, oh dear, oh dear. As my young son would say. Look, I'm known for not being shy with my opinions, Yaniv, and I'm going to probably make some people upset here. If you are a founder with any competency at all, you need to, A, be clear whether you're raising money or you're partnering with another firm to build a business. Often these firms are called venture studios, or they're agencies who are willing to donate time and resources. I'm not a big fan of venture studios, or rather, I actually don't think these are venture studios. I'm not a fan of VCs who are providing tons and tons of services. So venture studios, actually, they come up with a whole bunch of ideas, or they adopt founders and they spin them up quickly and then they spin them out. And these world-class venture studios can be really good. Expa is an example of one of those with Garrett Camp, the co-founder of Uber. These are not venture studios so much as agencies that put in a little money and invest a bunch of services. And that is generally a non-starter for me. The services and the value of those services are fungible. You're tied to an entire infrastructure that you have no idea of its quality. You have all of these mixed wires and mixed incentives. And as we can see from these horror stories, like they're just taking huge chunks of the company and leaving you holding not very much. And so, if you are going out to raise money from investors, do not confuse an investor with some kind of quid pro quo sweat equity deal with an agency. Those are two different things. And if you conflate them, you will be in really bad shape and be really upset at the end of this process.
Yeah. I mean, one way to think about this is I think that there is a bit of a continuum, right? Which is having an agency partner to whom you're effectively giving sweat equity, having a VC with a lot of value added service. But in those cases, what you are saying is, I'm still the founder. And what we're seeing in this case, 51% equity being taken, 75% equity being taken, that is not a reasonable amount of sweat equity or equity to give away in general to an outsider. And when I say an outsider, I mean anyone who's not a founder, right? Like an investor or an advisor or anything like that. I think there can be a model that falls under the venture studio umbrella where the venture studio is effectively your co-founder, right? Where you're like, okay, they are bringing a huge amount to bear. They believe in me. They believe in my idea. They've got a lot of resources. They're going to build it with me. And in that case, it's like, well, okay, if it's a 50-50 split, I can see a world in which that would work. But then you need to assess that venture studio the way you would assess any other co-founder to bring on board. Like, it's a bit of a different model, but are they fully committed? Do they really believe in your idea? Do you have a clear split of responsibilities? Are you all going to pull your weight? Do you get on well together? All of these things. Bringing on a co-founder is a huge deal. We have a whole episode on that. If we're talking about anything north of 20% equity, then really what you're talking about de facto is bringing on a co-founder. And the only way you're ever going to raise future capital is if it is plausible to future investors that this studio is effectively acting as a co-founder. And even then, honestly, it's probably going to make your life difficult. So I think part of what you get with this venture studio as a co-founder is an ability to bootstrap for longer because effectively they have their own sources of money to sort of keep things going.
You cannot outsource the development of your startup. It's just not possible. A big part of startups is a founding and operational team who knows what they're doing. That's what investors are investing in, and that's what's going to carry you through all of the roller coaster ride and the blood, sweat, and tears. So this first story of they wanted to take 51% of my startup and they promised to do everything, market the product and sell the product and develop the product, and you're outsourcing your idea to someone else and hoping that they're going to go do it for you. That's not the way startups work. You can onboard an agency that maybe has some engineers to help you spin up your MVP. And they might do that for a little bit of equity in lieu of cash. And they might end up with 1, 2, 3, 5%, 7%, maybe 10% of your company. But it's your company. And this is not just about what will work, because a lot of these things don't work, but rather what is going to work at seed and Series A and Series B. Is anybody going to invest in a company that has a venture studio hanging off the back of it and has a founder who didn't believe in him or herself enough to keep 70 some plus % of the equity at the first stage? So you're setting yourself up for failure from day zero. And so these stories didn't go off the rails when the venture studio, quote unquote, didn't come through. These stories went off the rails when the founder tried to outsource their startup to someone else.
Yeah, I think that's a really interesting point, Chris. And actually, if I reread these two with a critical eye and play devil's advocate, or rather just the other side of this, the investor took 51% of the startup in return for developing, marketing, and selling the product. Well, that's the whole damn thing. What is Anon here doing for the 49% they get to keep? Right. And similarly, for the second one, I think it's an interesting phrasing here, right? Which was they essentially wanted 75% of my idea.
Yes, I
And
noticed that part
that
too.
seemed hard, right? But like, what was it? Episode 2, episode 3 or something? It's like, your idea is cheap. I think we actually said your idea is worthless. The
Right.
work is in building the thing. So in a sense, I think what these two people, at least in how they've presented this, are not making clear is what they're bringing to the table beyond the fact that they have this idea. And so in some sense, the venture studios are giving them a good deal. I'm sure that's not actually what happened. So I think the point here is, yes, you cannot outsource this thing. You can't say, I have an idea and I'm finding a venture studio to build it for me. You are the founder. You need to build the thing. You can, must, of course, get help building it. That's why you bring on co-founders. That's why you hire people, but you don't outsource it. And if you're not outsourcing it, then you need to keep most of the equity. So yes, I agree with what you're saying, Chris. This whole thing comes nearly from a misapprehension of what it means to be a founder and what it takes to be successful as a founder.
Unfortunately, it's inexperienced founders being taken advantage of by inexperienced agencies. These are agencies, people who've got deal flow, likely project work, contract work from other sources, from third party paying clients. And they're like, hey, this startup game is cool. We don't have any ideas of our own, or we have a few of our own ideas, but people keep coming to us with ideas. Why don't we figure out a model where we can take a bunch of equity and try to monetize some other stuff? And both parties are inexperienced and both parties are screwing themselves and screwing each other. And so you want to find serious investors who are interested in investing cash, or you want to find serious vendors who are interested in providing services, and those services have a price tag and you pay for them with cash or a little bit of equity or a mix of both. But don't conflate and confuse these two things. That just gets messy, and it's typically people who don't know what they're doing. All right, the next horror story is about sharing with competitors. This person wanted to stay anonymous, and their story is, we had a first call with a third tier investor. I'd love to know how they're classifying those tiers earlier in the day, and then they requested a follow-up call at 10 p.m. On the second call, the partner and associate invited a portfolio company / competitor without telling us. They asked us to go through the demo again and describe our technical approach to various problems. They claimed they were looking for synergies, using quotes. We told them no, of course. Painfully awkward, received a generic rejection email the next day. So, Yanev, what should you do if either in the room or through back channel, you suspect that the VC you're talking to is funneling information to someone in their portfolio, especially a competitor in their portfolio?
Goodness. So this is a tough one, actually. First of all, for those of you listening, if you've not watched the TV series Silicon Valley, you must go watch it. It is a satire, and like all good satires, it's actually based on an extremely strong foundation in reality. And I think it's in season 2 they go through this, and they call it getting brain raped. And this is exactly what's going on here, right? Which is basically they are just pumping you for useful information for their own portfolio. The reason I'm hesitating in answering this in really black and white terms is I think there is a reality that it's worth as founders being aware of and accepting to a certain extent, which is that investors share information with each other, and often information that they shouldn't quite be sharing, right? It's part of the sort of the network of favors that investors do for each other, where one investor might say, oh, I've got a deck for a company that's competing with someone in your portfolio. Would you like to have a look at it so that you get a better sense of the competitive landscape and so on? So I think there are shades of gray here. First of all, let's go back to the concept that your idea is cheap. Your pitch deck, your idea of what you're trying to build, there's likely nothing in there that is going to give your competitors a significant advantage, right? You're saying, hey, here's my idea. Here's how I'm going to approach it. Like your competitors have probably thought of that too. There's no like unique IP in your pitch deck that you should really be all that worried about. But then there is more trade secret type information. And this is where you should simply have your guard up and ask yourself, why is my investor so interested in this? But if there's an investor that you're pitching, there is give and take here. They shouldn't be asking for information they don't need to analyze this stuff. And they sure as hell shouldn't have anyone in the room who is not part of the investment committee. So I think this horror story is kind of funny because it was just so grotesquely obvious and over the line. But I think the interesting takeaway from this, Chris, is there are shades of gray and you should have your guard up. And you should know which of your information is actually valuable to competitors and which information you should just not worry about and accept that it's going to be shared.
Yeah, this is a difficult one because you're right, Yanev, that ideas are worthless and your instincts and your intuitions about how you're going to go execute and how you're thinking about things are likely to change and pivot. And so you want to not hold those things too dearly. And this is one of the reasons why investors don't sign NDAs, because they see a lot of deals, many that might be similar to yours, and they can't be accused of something they haven't done. Now, on the other side, though, these investors need to act ethically, right? They shouldn't be funneling wholesale stuff to competitors, especially competitors in other portfolios. I think there is a line where you might give a portfolio company a heads up about something, but actively reaching out and passing on your deck to other investors for their portfolio feels like crossing a line to me. What will
Mm.
happen in Silicon Valley, at least, is you may, as part of their vetting process, be introduced to founders who are in the same space as you. Maybe even you might perceive them as a competitor, but they're actually focused on a different persona, a different part of the problem, and what have you. And the investor will send you there to ask that founder to vet you, to ask, like, hey, what do you think about this in someone in the space who thinks deeply about this? And I've been sent many a founder to talk to, and I've been asked to do reference checks on many a startup. And so that's actually not too uncommon. But you don't want to, as you said, Yaniv, be giving them like in depth trade secrets. You just want to be talking about the concepts at a high level. And then the final thing is connected to what I just said, which is the world is very, very big. In Silicon Valley, it's not unheard of for two, three, four people in the same category of startup. Like you might even say, like three people building foundation models in AI for a sake of argument, OpenAI and Anthropic and Facebook. It's not unheard of for these guys to talk to each other and actually
Mhm.
share some insights and what have you, because they
Mhm.
know that they're specializing and they're focused on different things. And so the world is seen in the valley as abundant. There's like, 7 billion people in the world, and you're not going to go take the whole market. This feels less true in second and third tier markets like in Australia, like in New Zealand, like a small European country. But it is fundamentally true that you have to believe in the abundance in the world. So just to put a button on this, VCs have to act ethically and they should not be sharing proprietary, private, and sensitive data with their portfolio and with their other VCs. Whiffs of information, rumors of information definitely permeate, but you need to be focused on your own momentum and trajectory rather than trying to protect everything jealously.
I think that's actually the bigger takeaway. VCs have an obligation to act ethically. They won't always do so unless they are completely blatant about it. Like in the case of this story, you will never know whether or not they acted ethically. But for the most part, just don't worry about it. Again, your ideas are cheap. Even certain information about like your trajectory or your runway or your customer acquisition costs, they have some value. But let me tell you, like being paranoid is far more of a distraction than that information leaking is a competitive threat to you. So, to a close approximation, unless you have real trade secret source stuff, 11 herbs and spices, chill. That would be my kind of takeaway from that.
And just one last point. The worst part of this is if they're a direct competitor, clearly going after the same space, and they were sitting in the room with you during your complete and thorough pitch, that does definitely feel weird and unusual. But the pretense is the thing that gets me is like they're looking for synergies, right? You guys have heard me talk about partnerships before. Partnerships tend to suck in the early stages. Most of them just suck. Distribution partnerships, as well as synergistic technical partnerships and whatever the hell else. If a VC is saying, I'm going to pass you one of these guys to vet you, I want to hear their opinion about the space, that's one thing. The other is like our investing in you is dependent on a synergy with some other company. That idea is a little distracting. Investing in you shouldn't be dependent on a synergy with one specific other company. That feels a little bit missing the point.
Okay, so the next horror story is about lowball offers, and an anonymous listener writes to us: Y Combinator Company raising seed round after demo day. An investor offered to do an investment at 50% of the valuation after the round was 60% filled. This person claims to be founder friendly, but reality is further from the truth.
Yeah, so they've actually named the investor in the question. We won't share the name here. I actually know this person and he is a little bit of a pain in the ass. And yeah, this is an example of a lowball offer, right? You as a founder are going to go to a lot of investors and some of them don't understand the game that they want to invest to a sufficient degree that that company is set up for success, right? To take the oxygen out of the room, to hit their next milestones and to make it all the way to the next round. That's the goal of any good investor. And when they start to try to lowball you on the amount of money they want to give you or the valuation of that money, they're playing the wrong kind of game, especially if they're nickel and diming, like they're trying to move percentages here and there when it really, the broad strokes are roughly right. In this particular case, they're trying to do 50% of the valuation when the round is at 60% filled. There's already a good amount of momentum for a YC company. This investor is just trying to throw a Hail Mary and see what happens. But just watch out for these investors who are less concerned with how much money it'll take to win than they are with how little money they can get away with giving you at how little evaluation they can get. That is the wrong mindset from the investor. This whole game is about signaling. The investor is looking for signal that this founder and this company is great. And the founder should be looking for signal that this investor has the right mindset and is asking the right questions. If there's no signal fit, you need to politely walk away.
So this is really interesting. I was getting involved in a conversation just yesterday on LinkedIn about what a lot of founders are seeing, which is that investors at the moment in this market are asking for seed level metrics at pre-seed and for Series A level metrics at seed, right? So in other words, they're looking for more traction, more revenue, more validation than is really reasonable or realistic at that stage. And I expressed effectively my frustration at this. And another person on LinkedIn, another founder said, maybe some founders will get desperate and take the offers. Maybe that's the investor's plan. And I responded and said, if that's the plan, it's a bad one. A poisoned cap table, an underfunded business, and a diluted founder will not lead to a strong outcome. And so the point here is that with valuation, you actually want to hit this sweet spot where the founder and investors' incentives are kind of aligned. Now, it's certainly possible for offers to go too high, for valuations to go too high. I think we've spoken about that, but during the great zero interest rate bubble of 2021, valuations went too high, and that's not good for founders either, even though it's exciting. But on the flip side, having valuations go too low, it's not good for founders, of course, but it's not good for investors either. And the reason is that you end up with a company that is basically underbaked, that it doesn't have the resources it needs to validate, to prove, to learn the things that it needs to validate, prove, and learn. And or you get an investor who is overly diluted. The investor takes too much equity, too high a percentage of the company. And we've discussed this before on the show. A normal round might be 10, 15, 20% dilution. If you get to 40% dilution because the valuation is too low, then the founder is diluted. Future investors are going to be like, I'm not investing in this company because the cap table is fucked. So these investors who are trying to lowball you are cutting off their nose to spite their face. Now, lowballing doesn't mean that you're not getting the valuation that you want, right? You might want to listen to investors, and some investors might actually just have a more realistic view of what is an appropriate valuation. And again, you're often better off taking smart money at a lower valuation than dumb money who you've managed to convince to go at too high a valuation. But if they're just trying to screw you, they will screw you, but they're also screwing themselves. So it's just a dumb thing to be doing.
People just don't think three-dimensionally. They don't think about the long-term thing, and
You're
and
not
they don't
thinking fourth dimensionally, Marty.
exactly, and they don't understand the game they're playing. The moment that money hits your bank account, you are now sitting on the same side of the table with that investor. And that investor is sitting in a poisoned chalice. Congratulations. You crippled the vehicle and then you sat inside. And it's like your getaway car is fucked.
But it was cheap.
But it was cheap, exactly. There is this natural tension that should naturally stop the company's valuation to be too high because it'll screw you on the next round. You'll have to take a down round. You won't grow into that valuation. And there should be a natural tension to stop the valuation being too low because the company will be undercapitalized and the founder will be far too diluted. It's very simple. Understand the game you're playing and play it for the long term.
This episode of the Startup Podcast is brought to you by Vanta. The team at Vanta are passionate about helping you secure your business by vastly cutting down on the time to get compliant with frameworks like ISO 27001, SOC 2, and Essential 8. Vanta lets you close deals, sleep better at night, and get back to building your product. Help yourself and help the podcast by going to vanta.com/TSP for an exclusive 20% off deal.
All right. The next horror story is about failing to help. Anonymous, again, says a VC invested and then totally disappeared, would schedule meetings and then cancel and add no value, this person says. All the ways that VCs say they can help you are fake. Founders just have to help themselves. Well, I think the best investors can be very, very helpful. Starting from just their brand, their reputation, right? Having Sequoia, Greylock, Benchmark on your cap table, just as a matter of brand, is a big win, a big signal of validation, right? And then, of course, the personal reputations of the general partners is huge. And then their network, VCs they co-invest with, and their portfolio of incredible founders with their own incredible networks, the amount of value they add on your board and the insights and the pattern matching and how deep their pockets are for follow-on rounds, right? There is a lot to be said about high quality tier one investors and how much they can help way, way beyond their capital. But at the same time, you need to kind of hope for the best and plan for the worst. Your investor is there to fundamentally provide capital. That is the baseline of what you should expect from them. Anything more is very valuable, very necessary, but ultimately going to be frosting on the cake, especially with a second or third tier investor, and double especially if you're in a second or third tier market. And so you do not want investors that are going to be toxic and are going to lowball you and what have you. But I think if you can just get clean capital, free of strings and free of distraction, I think that's probably a good enough outcome for many founders in many markets outside of the hot tech hubs.
This is not a horror story. This is a mild disappointment story. Completely agree with you, Chris. Our first ever guest on this podcast, Nick Crocker from Blackbird Capital, he said one of his contrarian views is that no venture capital adds that much value, that really it's about the money and everything else is just investors kind of fooling themselves, telling themselves stories, and also pitching to founders. And there was a level of self deprecation and modesty there, but it's definitely true. This is a financial transaction primarily. Help is icing on the cake. So if you can get it, great. If you get it from a good investor, even better. But I'll tell you what, you are much better off with this sort of no strings attached money. It's like, here's your money. I said I would help, but actually now I'm ghosting you, than investors who get up in your grill with bad advice, who take up your time, who just soak up your energy by trying to help, and that they are a net negative. You're much better off with capital and net zero value add, because all too often that money comes with a net negative value add. So Anon, I know you're a bit bummed this person ghosted you, and that's not cool, but you've got their money and they're not getting in your way. So I think you should be grateful for small mercies there.
The motto for an investor should be first do no harm. And this is connected to the first horror stories right around venture studios. They're the opposite. They want to do the whole thing for you and pretend they can completely solve your business problems. It's the other polarity, right? The idea that you can outsource the business to us, we'll take it from here, is nonsense. And the idea that a VC is going to materially move the needle on your business is mostly nonsense, unless those VCs are like just incredible first tier guys who are plugged into everything.
Okay, here's the next one. Now, this really is a blood boiler. This is a horror story, which is delay in payments as a weapon. This person, another anonymous listener, wrote in and said, investors signed a safe, but would not transfer the money for months. What's even the point? Then we figured they have invested in a competitor, and this was their way to derail or slow us. Wow.
Wow.
This is a perfect example of capital being weaponized. In this case, in quite a clever way, in an evil and clever way, right? Remember, term sheets are actually non-binding, but even a binding contract is like, if you're a startup that's running out of money, you're not going to go ahead and sue that investor for breach of contract, are you? So really, you have to trust that the investor is going to do the right thing. In this case, they didn't do the right thing. And, this is just one of those things that happens. And if this one was named by the listener, I would have named and shamed them, because the only way that investors are going to pay the price for this sort of behavior is reputationally. There is no financial cost to that. When I started reading this one, Chris, where I thought it was going to go is that the investor signed a term sheet and then nothing happened for a while. And then they were like, oh, as he started running out of money, they started adding additional terms or lowering the valuation and that sort of thing. I hear that kind of story quite often too. Which again, it's like they're holding you hostage. You're a starving person in a desert and they've got a whole bunch of food for you, right? And the hungrier you get, the closer to death you get, the more leverage they have. And yeah, that is just awful.
Yeah, they're saying they suspect that this was using the fundraising process as a weapon to try to slow them down vis-a-vis their competitor. That's just a suspicion they have, and I've never really quite heard of that happening before. But if that's actually true, which I'm a bit skeptical that it is, but if that's actually true, that is unethical in the highest degree. And so, yeah, you just got to vet your founders. You got to check their Google reviews. You got to speak to other founders who are in their portfolio. While they're doing diligence on you, you got to do diligence on them. It's that simple. We've said this multiple times in the episode. I've said this multiple times on LinkedIn. You are not pitching a VC, even though they call it that. They're pitching you and you're pitching them. It is like dating. You need to understand who they are, what their priorities are, what their biases are, and are they going to first do no harm? And you need to check into their reputation, how they are to work with, and check in with their current and former portfolio founders.
I share your skepticism, Chris. Like, it could be that this happened. It is also possible that it didn't happen. And I think, as much as it is true that investors do often use the timing of capital transfers as a bit of a weapon, as leverage, I would also put a cautionary note and a slight admonition out to founders there, which is that for a bunch of completely innocent reasons, it can take time for money to land. And you need to account for that. So when my startup Circular was raising its last round, it actually took 3 to 4 months from signed term sheet to delivery of capital. And that was painful for us. Won't deny it. But it was just a whole bunch of like innocuous due diligence. And then, our lawyer had COVID and their lawyer had COVID and all of these things that just slowed things down. And so the point is, capital raising process doesn't end when you have a signed term sheet. The capital raising process ends when the money is in the bank. And there can be a significant lag. And often people, I think, especially first time founders, don't realize that there could be a significant lag. And it's not always investors trying to screw you. And you need to have a plan. And the main thing about having that plan is actually starting your raise early enough. Also understanding that term sheets are non-binding, and ethical investors will not pull a signed term sheet unless there's a good reason to, but sometimes there will be a good reason to, and sometimes the investors won't be ethical. So the real lesson here is do not count your chickens before they hatch. Do not count on having that money and spending that money. Don't add that money to your runway until it's in the bank. And that is on you as founders, right? This isn't kindergarten. Like, you have to look out for yourself. And that's simply a fact. Money's not in the bank. You can't spend it yet. And you need to be aware of that. Now, there's another story that Chris and I were talking about that sort of doesn't quite fit into VC horror stories, but very much fits into this cautionary tale, which is that I heard from a founder recently who has been trying to raise for a while, and they're down to like weeks of runway and they're still trying to raise. And what I said to this person is like, this is red alert. You have to do absolutely everything to preserve that tiny amount of cash you have left, because this is a really difficult way to be raising capital. And I think it's doubly problematic because, first of all, hope is not a strategy. It is unreasonable to think that somehow the money will come through in the next few weeks is too big a risk, really. And then the other thing is, even if they are able to find an investor, the cash may not land in time. And there are laws in most countries about trading while insolvent and so on. So you have to be very careful. One of the games of being a founder is never run out of money. Like, you have this big vision and you've got all these games that you play of raising capital and financial engineering, whatever else you do. But there is a sort of base rule of business that you have to always be aware of, which is that line can never dip below zero. And it is on you as a founder to make sure that happens, not on anybody else.
Yeah, that's right. And we have a whole episode about fundraising 101 in our back catalog that you should go listen to, guys, if you're interested. But I mean, the key point we're making here is the fundraising takes a long time. It takes a long, long time. And if you are an unknown quantity, you don't have a startup in your past, you don't have investors in your phone contacts, you could do a roadshow where you're just getting to know investors. Then there's the fundraising, then there's the diligence, then there's the term sheets, and then there's the money transfer delays. It could easily take 3, 6, 12 months. So you really need to start early. You need to be diligent. You need to run a process, and you need to make everybody aware of the timing and keep everyone moving as quickly as possible. All right. The final horror story is a fake Shark Tank. Nick Robertson here is one of the only people who's brave enough to put his name on these things. So thanks, Nick. Talked about going out for a pitch contest and was to receive $50,000. So he obviously won the pitch and got a commitment on stage for $50,000. On the night, hosts promised over $1 million total to all the startups. At their next pitch night, they promised over $2 million. I met with these guys 3 times, and on the 3rd meeting, they said, "You don't need us, you'll be fine." My price turned out to be 3 meetings, and I paid for the coffee. None of the 8 startups they promised money to actually received a dollar. It was a blockchain company, of course, he says.
Of course.
We've talked a lot about unethical VCs here. There's a lot of stagecraft and showmanship that happens on these pitch days. And yeah, the idea is when you say on stage you're going to give you the money, you're supposed to give the money. And I've heard more than once that this doesn't actually materialize into real dollars in bank accounts. And it's ridiculous. And these people need to kind of be named and shamed. You need to call them out. If they're going to represent that they're making calls on stage, then they should follow through on those calls. And it's just basically bullshit. But I will, just on a broader point here, again, maybe I have a certain perspective coming from Silicon Valley, but I'm not super enthusiastic about these constant pitch competitions and constant community activities that can really distract founders. And it's like, how good is your pitch? And let's go do this thing and that thing. And it's like, just build a real business, have real meetings, close real money. Maybe that comes from a place of privilege or a place of cynicism or undue cynicism. Maybe I'm thinking about tier 1 marketplaces, but there's the innovation theater, there is the tokenism and the frivolity, and then there is seriously building a company and having serious conversations with serious people with seriousness of purpose and executing in a methodical and thorough, and I'll say it again, serious way. I would encourage founders to pay most attention, if not all attention, to that path.
The phrase that popped into my head for some reason is another podcast that I'm sure a lot of you folks listen to called My First Million. It's a fairly irreverent sort of business podcast. One of their slogans is no small boy stuff. And so, of course, we believe in diversity in founders. So this is no small person stuff, but the point remains the same. Don't focus on playing these little games and on getting distracted by baubles. You're an adult in an adult world, and it's an amazing world, and engage with it directly and expect a lot from it and deliver a lot to it.
And expect a lot from yourself. Right, I
Absolutely.
can't tell you the number of founders who are the implicit thing that's going on is that they're not having faith in themselves and they're not sticking to their vision or asking for the right amount of money or what have you because there's some amount of imposter syndrome or undervaluing what they've built. They're compromising and going off into distractions, which ultimately is a self-fulfilling prophecy. And oftentimes when I'll try to lead them back to their original vision, which is quite disruptive and quite compelling, they're like, "Oh yeah, Chris, but we don't know if anyone's going to fund that, or that's more risky, or we don't know if we can
Mm.
execute that." It's like, well, then what the fuck else are you doing? What else are you doing? The whole point of your company is to execute that disruption. Do it, bet on it, and fail in the trying, or succeed and go big. Put on your big boy and girl pants and take it to market.
I agree. And it's like, it's not that pitch nights have no value, but for example, some pitch nights, they determine a winner. And it's like, I won the pitch night. And you know what? That is pointless. Winning a pitch is getting funded. The best way to know whether your pitch is fundable is to try to get funding, not to win a pitch night. And so pitch nights can be valuable for community building, perhaps for getting some feedback. Although, again, I would argue that feedback from investors rejecting you is probably a much more direct path to success. But yes, if the game becomes the goal, then that becomes quite dangerous. And then, another thing I'd sort of point out about this thing where, Nick won the pitch contest, he was set to receive $50,000, and what he got was 3 meetings that were deemed to be worth $50,000 because they were so valuable. I do see more commonly happening investment term sheets where the investor is not just giving capital to the business, but they're also extracting fees. So they're giving with one hand and taking with the other. And in fact, I spoke to a founder recently who got this sort of term sheet where there was a certain amount of funding, but then the investor was going to take some of it back as like an advice fee for their so-called value add. So in this case, the value add wasn't even free. So it's probably not going to be very valuable, but it wasn't even free. And then they wanted a finder's fee for introducing new investors to the round. So they would take a cut. They would take a cut of new funding if that funding came from an investor that they introduced. Now, this is bullshit, folks. The strings that are attached should be around control provisions, for example, board seats or whatever. But the flow of money should only ever be in one direction. You should never be paying your investors a cent.
So this is our final and bonus horror story, right, Yaniv? This is the investors charging fees. I think it is connected to these so-called venture studios. The idea that we're not just giving you money, we're giving you services, or we're giving you a virtual amount of money and then we're taking some of it back as services or other nonsense, right? And it's just like, go find an investor who can give you money, period. Full stop. That's what investors do. They should not be charging you for their advice and their introductions. On the back end, they might go put together a syndicate and take 20% carry from the investors that they're bringing to the table. But if they're just making an intro rather than collecting the funds and creating the special purpose vehicle, then there's no finder's fee for that. And just, I guess, the mental model to have in your head, guys, is like, it's stone soup. Everyone's contributing the thing that they're uniquely qualified to contribute. And once they contribute, they're in the boat with you. They're on the cap table. And so once they own equity, they should be helping to maximize the value of that vehicle, of that entity. And so when they start nickel and diming you on the valuation, they start trying to charge you for fees and services, and they're trying to take a cut of an introduction, these people don't understand the game they're playing. When they're trying to do hybrid nonsense, like we'll give you services on one hand and cash in the other and whatever, it's just like, play your role, understand who you are, and we're going to build a team of experts, team of rock stars who are specialists at what they do, and let's go build this serious company. And so just understand these roles, guys, and play them well. Keep it clean and straightforward and just execute well. All right, guys. Now that is the end of our horror stories for this week. Now we want to make this fair, right? So we put a call out for founders to share horror stories about their VCs. Now is the chance for VCs to get back at them. There's fewer VCs, so we'll see how this goes. But if you're an investor, an angel, a VC, private equity, whatever, you've put money into a company or you've been pitched by a company and something has gone a little awry, we want to hear from you. Go to tsp.show and submit your founder horror stories and startup horror stories. And actually, if you have any suggestions for the show, topics you want to suggest, feedback for Yaniv and I, go to that same form, the submission form at tsp.show. We would love to hear from you, and you might hear your name or at least your story read out on air on the show.
Okay, Chris. So imagine that you're a founder and you're raising capital and you're just not sure how to sort the wheat from the chaff and, what's a reasonable term sheet from an unreasonable one. You want advice on the whole thing, on how to position your product and how to raise that capital from good investors. Chris, I know you provide all sorts of advice. So if folks want to work with you, how do they do that?
Yeah, that's right. And if you want to avoid these horror stories and run a serious business with a serious process, that's what I help companies do. So I do work with a small handful at any given time. You can learn more about that over at chrissard.com/advisory.
And don't forget, if you are a regular listener of this podcast and you are getting value from what we give you, you have implicitly signed on to the Startup Podcast Pact. That means that you have signed on to help us spread the word and get in the ears of more founders, operators, and investors. And you can do that by giving us a shout out on LinkedIn, following us on YouTube, and writing a review in your favorite listening app. Thanks very much for your support. Until next week. See you, Chris.
See you later. Bye-bye.
This episode of the Startup Podcast was brought to you by Vanta. Vanta helps businesses get and stay compliant by automating up to 90% of the work for the most in-demand compliance frameworks. With over 200 integrations, you can easily monitor and secure the tools your business relies on. Head to vanta.com/TSP for 20% off their incredible offering and start unlocking extra revenue today. This episode of the Startup Podcast was brought to you by Insil. Most paid marketing campaigns have a negative ROI. Don't let that be you. Insil brings big brand expertise to small businesses across Australia and pride themselves on their no BS approach to driving traffic, leads, and sales for your business. They're award-winning, but more impressive in my view is the 4.8-star rating that they've earned on Google. Read the reviews, then jump on to insil.com.au and ask them how they can help you. Tell them we sent you.
Hey, I'm Chris.
Oh, sorry. Hello. And I'm Yaniv.
What the fuck is wrong with you?
Oh my God.
Oh,
Yeah,
shit.
this is going to be fun. You're going to have to carry this one.